Well, Netflix was down another 9.5% today, almost $14. As you can see from the chart, this thing had just been unbelievable. Had this great run, really starting back in early January 2010, so almost a 2-year run from $60 all the way up. It gone up fivefold to $300, a little over 300. It's now sitting at $130 a share, and this has just been since mid-July. So we're talking about really 2 months. The stock has dropped, over 50%. Just been a big, big drop, and it looks like it's probably heading lower. But let's examine it a little further. And this is one of those situations where I think you look at Netflix, and it was a stock that was in such a steady uptrend that if you owned it, the easiest exit strategy was when something changed or something was out of character for it. For example, you could look at the 50-day moving average here, which is the blue line, and you can see that it was pretty steady all the way up throughout this, and then, of course, it started to roll over. But even if you just simply said, well, let's just look at the uptrend that it was in, I mean, this thing was as steady. So that was your stop right in here. And, when it got to that point, that was the point when it broke through there that you wanted to sell this. Now, for those that have been wanting it, and I'm somebody that wanted it back early on, and I never bought it. I told myself if it dipped below 100 this was back early last year, 2010. I said said this to myself, if it broke 100, I would be a buyer. And it literally, as you can see, went below 100 intraday for about 10 minutes, and then took back off again and off to the races. And then it became, once it kept going up, it became a valuation concern for me. I mean, yes, it's a fast-growing company. Everybody I know uses their service. Is it saturated yet? I don't know, but it got to the point where the valuation didn't make a lot of sense. And so then it became a momentum stock, and it was all about when is this thing going to break. And, of course, even people that were short the stock were capitulating and saying, you know what, we're wrong, we're covered our short, we're taking our loss, and we're going to not going to buy the stock, but we're certainly not going to bet against it. And so all of those people that were short basically were looking for a higher place to reestablish the short at some point. And so you were just waiting for this thing to break, and it was a long road, right? It just kept going higher and higher and higher. And it finally broke, and it kind of started with the issue with Stars. They were questioning whether they would renew their contract with Netflix, and that kind of started it, it seemed like, and really there were some concerns. And also, don't forget that the president came out a few months ago and said, we're going to increase prices, and basically, if you want to get the DVDs actually sent to you in the mail, and you want to continue to get streaming on your computer, it's going to cost you more. We're going to have basically an extra fee there. And so that didn't make a lot of people happy. And, of course, yesterday he came out and apologized for that, which was kind of strange. But anyways, the stock has been falling ever since, and you can see the huge volume spike there on the right in the last few days. So this is going to be a stock for the next few weeks. It's going to be a day trader or a swing trader's dream, because when you get a stock that has fallen, well over 50%, you get people come in that A, wanted it and think it's a value stock and buy it, or B, just simply know the volatility is there and they want to trade that volatility. So again, the thing's starting to, it's a broken stock. So looking back at a lot of different companies when they do this, you inevitably get the bargain hunters that come in there. So I do expect a bounce any day now, a pretty substantial bounce, because the shorts have been piling on. But I think you're going to get a substantial bounce, but it's broken. So don't look for the stock to resume this uptrend and be in the upper 200s anytime soon. Now, before we get into the technical parts of Netflix, let's go and look at the fundamental story, because obviously the reason the stock had been going up so fast, what really turned me onto it originally a couple of years ago, was the fact that I listened to a lot of technology podcasts, kind of a tech junkie, and the people that are kind of those early adopters, what I noticed was they were all talking about Netflix. Netflix was advertising everywhere, and they were getting their distribution was just going crazy. They were really putting their ability to get into your home in Xboxes and all these gaming systems, so they made it very simple for you if you wanted to get Netflix. There's a lot of different ways to get the movies streaming, and for $8 or $9 a month, whatever it is, seemed like a really good deal. So I started to hear more and more about it, and the earnings have just gone crazy. 2010, $2.96 a share. These earnings have been going up and accelerating. I mean, growing at 30% a year, then 50%. Now, the estimates are for 452 this year when we take the last 2 quarters in, and then next year it's for 670. So if you were to look at that, you would say, boy, this company's earnings are growing at 50% a year, so I'm willing to pay a pretty fat PE for that, right? You're willing to pay a higher valuation for that stock because the growth is there. If that's the case, we look at their PE ratio, and as you guys know from listening to me a long time, I'm not a huge PE ratio guy, but I do think obviously it does matter. It's in the it's a piece of the overall pie when we look at valuing a company and determine if it's cheap or not. If the company can maintain those earnings, and that's the big if, because in the PE ratio, the E is a big unknown sometimes, right? If their growth is slowing down, then obviously the E could be much, much lower, and you don't really know what you're paying for it. But if you look at what's happened in just the last couple of months, look, this PE ratio on the stock reached a high of 80 February 18th. 80 was the PE ratio. The stock at that time was in the mid-200s. It actually went up even higher, got to over 300, as I stated earlier, yet the PE ratio started to fall a little bit. Now, this PE ratio, which was up at 80, is now sitting at 33. So 33, while high, isn't that high if the company continues to grow at 30, 40, or 50%. So now you start going, you know what? It was overvalued. Is it now at least either decently valued, or is it possibly undervalued? And so, again, we have to dig a little deeper than that, and that's not really the point of this, because I'm not looking to buy this right now because there's so many people betting against it. It's going to be a big tug-of-war, and I'm not really looking at it from a valuation standpoint to buy it either. I am pointing out, though, if you were somebody who thought it was too expensive and you've been wanting to buy it, obviously it's cheaper if, this is a big if their earnings come in what everybody thinks they are. If they don't, then obviously the stock could go much lower. And remember, the stock is going down not just because the people are taking profits. When the stock goes down from 300 down to 130, there's something else going on. So I think Wall Street, doesn't trust management because they made this big blunder with the pricing, which is a huge issue, and they got all their customers really mad at them. And number two, their earnings may not come in what we think. And I think the stock market is telling you that by the price of the stock falling. Now, when you've got a stock that has been moving that persistently, and it's so consistent on the way up, and the chart is so well defined, the best thing to do, especially if you're in this stock looking for an exit strategy, is to change it to a weekly picture. And that's the best thing, especially also if you're looking for it as a longer term investment. And one thing about Netflix is that when we looked at it on a weekly basis, you start to see things like the relative strength index weakening. And that was at the same time the stock was going up. Now, if you would have seen that divergence back here, of course, you would have missed out on a big portion of the gain. So it's not to say that, you first see that indicator and you exit the stock. I mean, you could have exited the stock 200 ago, 200 or 100 points ago, 200 points ago. But the point is that this negative divergence was developing. So at that point, when it starts developing like that, you have to go in there and say, okay, now that we see that developing, I have to put in some sell strategy. We're seeing these negative divergences. What's my sell strategy going to be? And in this case, it's very simple to see. I've got multiple moving averages up here. And I remember we're looking at a weekly picture, but it's very simple if you look at just a 20-week moving average, or if I have 21-week moving average, which is this purple line right in here. Once it broke that was kind of your time to sell, because once it broke that area, that was it. And now remember, it went from $300 down to $250 at that point. So it was a big change and a big drop before you got that sell signal. But when a stock has gone from literally $20 back in '08 up to $300, you're going to have to give it some room to breathe. For example, back here, and this was in middle of 2010 during the flash crash time, the stock went from 125 down to 99, and yet nothing changed. It didn't close below that moving average. So you're giving these stocks some room to breathe. Otherwise, you're going to get stopped out on something that's moved up this fast and that's this volatile. So you did notice that something definitely changed when it closed below that 20-day moving average, or 21-week moving average, I should say. Once it did that, the deal was over. So now the question is, where's this thing going from here? And if you're looking to get in, where's a good buy point? Now, the first thing you see is that, there was some consolidation in in May through October timeframe last year. Stock was trapped between $100 and $120, and then finally it broke out, right? So once it did break out above that, it kind of tested the 125 area, we'll call it, and then it was off to the races, never looked back. Now we're coming back to that area. So the first thing we have to look at is, number one, we've got a 200-week moving average coming up on $120. Number two, $125 was the previous breakout period. So I think $125 could be the spot to take a shot at it. And remember, it's already fallen from over $300 down to $130. So a bounce very, very soon is inevitable for a trade. And for those that want to take a shot at it, I think $125, $130 right now is going to be your spot. So if we zoom in here, and I know I keep switching charts here, as you guys know, some different charting services are better than others. And to be honest, I have a Bloomberg machine. I don't like the charting features on there as well as some of these others. So that's why you see me kind of bouncing around between different ones. But and find something that you're used to and that you're used to seeing the charts on there, and kind of stick with that. But different ones have different features. And so anyways, going back to this, if we kind of zoom in, and this is in the last, 3 months, where can Netflix bounce to? And the problem with Netflix today was the fact that it did bounce intraday. We had a nice bounce, and you can see here from the picture this morning, of course, it gapped down this morning, and all of a sudden it started to turn around. It went from about 130 to 135, and then sold off into the close and pretty much finished on the lows of the day. So not exactly what you're looking for. But if we zoom in here and we take a look at Netflix, where it can bounce, I mean, look, we have to go back, because it's fallen so much. We're going to have to go back to this $200 level, and then of course, we're looking at the 180, which is where about it opened down. That was back on September 15th, which was just 5 days ago. So it's continued to fall here. We need to see some type of rebound and a close higher than the low. So I wouldn't jump in just yet, but if we get down, let's just say tomorrow we open and it goes down to $125, which was that level we were talking about earlier. If it goes down there and bounces and closes somewhere higher than that, then you've got a frame of reference. That's your low point, and that's your stop area. So, but if it continues to gap down every day and close at the lows, which it's pretty much been doing for the last 4 days, then you can't just jump in there. But once it closes higher than it's been throughout the day, and so for example, if it goes down to 120 tomorrow or 122, and then it finishes at 128, then you've got a frame of reference where you can use the stop at the low of the day. So if the low is 122, put your stop there. But I think you can see a pretty substantial bounce here, given from where it came from, and it could last a few weeks. But this stock is setting up, that's reminding me of Research in Motion, RIM, R-I-M-M. It broke up here, gapped down again, kept getting weaker and weaker. Everybody that was trying to find the bottom, that was trying to buy it, kept losing money. And then finally it did reach a point of capitulation where it turned the corner, and we finally went up. And it had a nice rally. It went from $22 or so up to $33. That's a 50% move for those that got in at that point. But look what happened. It bounces just purely off technicals, and I'll zoom in a little bit for you here. It bounces purely on technicals, and then it settles down, and of course they come out with earnings that were just awful. So the stock had been telling you months in advance that things were getting worse for Research in Motion. And if we go back a year here, you can see, it had been falling from March all the way down until August. So the stock was telling you, hey, those earnings aren't going to be so great. I have a feeling Netflix is going to be the same way. Now, Netflix comes out with earnings on October 20th. So that gives us exactly 30 days from now, not trading days, but a whole month, including weekends, that this thing can bounce. But I have a feeling that the earnings are going to come in worse than expected. right? I mean, let's see if analysts start dropping estimates. I don't know if there's a big reason for them to drop estimates just yet, but of course, if they don't do that and they fail to meet those higher expectations of 98 cents per share, which is what they're supposed to earn for the previous quarter, if they do that on October 20th and they don't meet that level, the stock's going to gap down. So I have a feeling what you're going to see is a technical bounce between now and then, and probably a tradable one if you want to do that. And then you're going to see perhaps an earnings miss and the stock, go back down to these levels, these justified levels. So it's reminded me of research in motion. I think we have a template for that. But let's wait till we get a close higher than the low of the day. And then once you get that, then you can establish your trade, and your stop will be the low of that whatever that day is. And that can probably be a multi-day or even a few week trade until we come into earnings. And I would not want to own the stock coming into earnings, just given what's happened with it. So that's for you that want to trade something very aggressively and probably a pretty high reward, but you also have a high risk. I mean, but if you set your stop, and then you should be okay. But just remember that the stock has gapped down a few times here, and today it was down 10%, $13. So be careful that I'm not suggesting a day trade, although you can get into that, but I'm suggesting a multi-day trade for you aggressive traders that want to take advantage of that once we see some type of low established. All right, guys, carleggers.com, throughatraderseyes.com. Also, Google Plus, go give that a try. They just opened it up today, so you don't have to have an invitation to try it. Go join it. You can add me on there, and then all of my posts that I do on my site will be on there as well. It's a great place to put comments. I stopped doing comments on my website because I was getting so much spam, but I think Google Plus will be a great place for you to comment on some of the posts, and all the YouTube videos and so forth will be up there as well. So go check that out. Have a great day.